Right now, across Asia, a silent economic crisis is unfolding. From the Indian rupee to the Indonesian rupiah, local currencies are hitting historic lows against the US dollar. Food vendors are shrinking portions, fuel prices are soaring, and citizens are watching their purchasing power vanish, all due to global conflicts completely out of their control. But if you look closely at how governments are responding to this crisis, you'll realize something fascinating. This exact macroeconomic nightmare is the precise reason cryptocurrency was invented. Let's break down the hidden connection. When a local currency starts to collapse, governments usually panic. To stop wealth from leaving the country, they implement capital controls. In the current crisis, India actively penalized citizens trying to buy safe haven assets.
It's also hiked duties on gold and silver to 15%. India spent more than $72 billion importing gold this past year alone. The government has increased fuel prices.
Indonesia is taking similar drastic measures, tightly restricting how much foreign currency its citizens can even hold.
Capital control by the central bank to limit up to 25,000 US dollars to be exchanged.
This traps citizens in a melting currency, and this is exactly where crypto comes in. Public blockchains are permissionless and borderless. You don't need a government's permission to move it. When traditional exits are locked, crypto becomes the digital emergency exit. Because global goods are priced in dollars, a weaker local currency means importing anything becomes drastically more expensive. We aren't just talking about luxury goods. This crushes local business owners.
The price of soybeans used to be much cheaper, around $25 for 100 kilos, but now it has reached as high as $60. As for plastic packaging, it used to cost $1.50 per kilo, and now it has increased to $2.50. We've had to reduce the size of our servings. If we raised prices, people would stop buying it.
This forces citizens to look for hard assets. Bitcoin was explicitly engineered to be digital gold. In a world where your local currency is actively losing its value to cover fiscal deficits, a decentralized asset with a mathematically enforced supply limit of 21 million becomes incredibly attractive. But perhaps the deepest connection is the vulnerability of the global financial system itself. Even if an emerging market does everything right domestically, they are completely at the mercy of US monetary policy. High US interest rates literally pull the capital out of the rest of the world.
The US is sucking in so many savings from Asia. So say you were a Japanese investor, maybe you were interested in the Indian stock market in 2024, it was actually booming. But nowadays, because of what's happening in the US, a lot of those investors, Korean, Japanese, you name it, are actually going to the US.
The foundational vision of cryptocurrency wasn't just to replace cash. It was to create a neutral, non-sovereign global settlement layer. If international trade settled on an independent network, smaller economies wouldn't be collateral damage every time Washington changes its interest rates. However, there is an ironic twist. While the theory points to Bitcoin, the real-world data shows that citizens in these crisis zones are actually flocking to stablecoins, cryptocurrencies pegged directly to the US dollar. Why? Because in the middle of a panic, people need immediate stability. Since local banks restrict how many physical dollars citizens can buy, millions are using blockchain infrastructure simply to get their hands on digital US dollars. They are sidestepping the collapsing local banking system. The current strain in Asia isn't an isolated incident. It's a repeating pattern. And every time fiat stumbles, the core arguments for a decentralized alternative grow stronger. What do you think? Is crypto the ultimate escape hatch? Or does the reliance on stablecoins prove the US dollar is still king? Let me know below and subscribe for more macroeconomic breakdowns.